September's inflation numbers, the November ibon variable and fixed rate, plus why we keep buying ibons. Hello, members and super savers. I hope you're well this week. These are the 3 topics we'll be covering in today's video. Here's our front of video disclaimer as usual. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Let's do a brief recap of the September inflation numbers first. According to the Bureau of Labor Statistics release of the latest inflation numbers, the Consumer Price Index for all urban consumers, CPIU, rose 0.4% on a seasonally adjusted basis in September, after increasing 0.6% in August over the previous month. And if we hop onto the paragraph below, we can see that the index for shelter was the largest contributor to the monthly all items increase, accounting for over half of the increase. Gas prices were also a major contributor to last month's CPIU increase, as those of us who have to drive can attest to. On a year-over-year basis, the all items index increased 3.7% for the 12 months ending September, the same increase as the 12 months ending in August. So basically, we're here on this blue line versus the lowest point in June of this year. Now, some industry folks are celebrating the continuing downward shift in core inflation, this red line here. Remember, core inflation excludes more volatile food and energy prices and is one of the primary measures that central bank leaders and decision makers utilize for policy setting purposes. While this downward trend in core inflation is somewhat positive news, if you don't eat or drive, the fact remains that a year-over-year 4.1% increase in core inflation and 3.7% increase in CPIU means that the Fed is still quite a bit off from the 2% target inflation number. To make matters even more uncertain, 1. Employment appears to still be going strong. Jobs rose by 336,000 in September, almost twice what the market expected, and the unemployment rate was unchanged at 3.8%. Remember that strong job growth may be good news for those with new jobs. However, it's not necessarily viewed as positive news for the Fed and other inflation hawks, because strong job growth means that the Fed's tightening policies are not rolling across the broader economy as they would expect. 2. Oil prices may spike again given current conflicts in the Middle East. And 3. Our government continues to spend against the backdrop of a growing deficit. As we talked extensively about in this recent video on when we expect Treasury yields to peak, I've linked it in the video description below for those of you who haven't seen this yet. All this uncertainty, coupled with stickier than expected inflation, means that the FOMC meeting on November 1st will be an even harder one for Fed officials than normal in terms of decision making. In our mind, the Fed's rate decision come November will also depend a fair bit on how bank earnings reporting season pans out the rest of this month and how much progress Washington makes in their budget discussions for fiscal year 2024. And it seems like Washington literally can't sort their house out currently. So the possibility of a government shutdown in November, coupled with the unknown of more hiccups in the financial sector and the current geopolitical ambiguity, could be enough reasons for the Fed to simply continue with their wait and see and higher rates for longer messages. Basically, September's inflation numbers raised more questions than they answered about what will happen at November's FOMC meeting. Now, the question that the September inflation numbers did answer, though, and what's relevant for this video, is what the November ibon variable rate will be. So let's move on now to the next section of our video. Most of our Diamond NestEgg ibon fans should already be familiar with our November 2023 ibon variable rate tracking sheet. So, the CPIU number at the end of March is the starting point for the November 2023 ibon variable rate calculation. And now we have all the inflation numbers from the past 6 months that we need, bringing us to an actual 6-month percentage change in CPIU for all items of 1.97%. This translates into an annualized ibon variable rate of 3.94% for November 2023, higher than the current annualized ibon variable rate of 3.38%. This means that if you're holding ibons with a 0% fixed rate, like most of ours are, you'll be getting this annualized ibon rate of 3.94% for 6 months at your next ibon rate reset date. If we go to Treasury Direct's website, we can see that ibons purchased during this period have a fixed rate of 0%. So, that was the annualized ibon variable rate of 3.94% for November 2023. Now, let's move on to the November ibon fixed rate. As I mentioned in last month's inflation and ibon update, also linked in the video description below, the ibon fixed rate is what many of us long-term investors look at. Unfortunately, no one really seems to know how the Treasury sets the fixed rate on ibons. From what we've seen, though, it appears that the ibon fixed rate does more or less track the real yield on TIPS, Treasury inflation-protected securities, usually with a bit of time lag. And based on where real yields on 5-year and 10-year TIPS were trading at on the market last month, in mid-September, we had expected the November ibon fixed rate to be in the range of 1.10 to 1.30%. Well, the real yields on 5-year and 10-year TIPS have only gone up since then, as you can see here. The green line represents the real yield on 5-year TIPS, and the yellow line represents the real yield on 10-year TIPS. Both have been on an upward trajectory since the ibon fixed rate was last reset in May of this year to its current level of 0.9%, as you can see from this blue line here. Which means that in our mind, the ibon fixed rate come November should go even higher than our original predicted range of 1.10 to 1.30% in September. But hey, anything can happen in 2 weeks' time, or even in a weekend's time, as we've seen recently. So, given the overall market and world uncertainty right now, our ibon plan remains the same as last month. We'll wait until November after we know what the fixed rate is to decide whether we'll buy more ibons with new funds or redeem existing 0% fixed rate ibons to buy new ibons. If Treasury Direct follows the same schedule as they did the last time around, the new fixed rate for ibons will most likely only be announced to the public, you and me, on Tuesday, October 31st, 2023. Happy Halloween, right? Let's move on now to the next section of this video. I'm sure some of you are wondering why we keep buying ibons when we expect a fixed rate in the 1% plus range and the real yield on TIPS across all maturities is well above 2% at the moment. Well, it's because we view our ibons as an inflation-protected emergency and retirement fund. Once we've held our ibons for the minimum holding period of 12 months, we can redeem them with Treasury Direct anytime at full face value, or at least anytime when the website is up and running. And of course, with the usual early withdrawal penalty of the last 3 months' interest if redeemed within the first 5 years. The point is, with ibons, we know exactly what we'll get if or when we need to pull cash out of them unexpectedly. The same can't be said for TIPS. Even though TIPS also offer inflation protection like ibons do, TIPS can only be sold in the secondary market, meaning that TIPS prices are subject to market forces, market uncertainty, including interest rate uncertainty, inflation uncertainty, oil price uncertainty, just to name a few. If we ever had to sell our TIPS in an emergency situation because we needed that money, and I've tested this out, as some of you know, with those TIPS that Marcus forgot to tell me he bought, that sales price on those TIPS could be less than expected. And do you know when folks typically need their emergency money most? During times of uncertainty. And that's why TIPS, unlike ibons, generally do not work well as an emergency fund that can easily be converted into a known cash amount at even the worst of times. Check out this ibons versus TIPS video here from a few months back for more details on our thinking and to learn more about which inflation-protected security may be a better option for you. So that's why we tend to lean towards ibons rather than tips, because ibons serve a dual purpose for us, as inflation protection, but also as an emergency fund after they become redeemable at the 13-month point. Having said all that, if the November ibon fixed rate really doesn't end up in our happy place and tips stick around this current range or go even higher, I'll have to run a few numbers and see if we should just pick up some tips instead. So what about you? What's your ibon plan? Drop a comment below and let everyone know. And for those of you interested in the upcoming 5-year tips auction, stay tuned. We're hoping to get something out to you before the auction date on October 19th. All right, members and super savers, as always, I hope you enjoyed this video and learned something new. And if you did, I'd love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, sponsorship-free videos for a super saving community. Come for a chat in our next live member Q&A on October 27th at 5:30 p.m. Eastern Time. And check out our latest member videos. To learn more about Diamond NestEgg membership, check out this video here or visit our channel page or the join link in the video description below. See you again very soon with more brand new wealth building content for your financial journey.